Hi everyone, so let's take a look at the notion of international competitiveness. Okay, within this you must understand that this is really important when considering a country's current account position. When it comes to Germany, of course, they are cited as an example of a country which is highly competitive internationally, as is the Chinese economy as well. Other economies are less competitive, and by that same sort of definition you could therefore argue that the UK economy does exhibit certain signs of a lack of international competitiveness, and that's perhaps highlighted by the trade deficit and subsequent current account deficit that the UK economy therefore runs. So international competitiveness, it refers to a country's abilities to sell its goods and services in domestic and international markets at a suitable price and volume. Okay, so there's going to be many factors that go into the actual competitiveness of a given product. That may well be design elements, the aesthetics of the product, the durability, non-price competitive factors in essence. So these are factors which are likely to mean that products are heterogeneous or differentiated as opposed to homogeneous goods. So those countries with homogeneous goods, they may not have the same degree of competitiveness unless they can actually compete upon price. So when it comes to homogeneous goods, price competition is all important. Right, so there's a number of other factors that we need to consider when we're actually looking at the relative competitiveness of a particular economy. I've noted just 5 down here. The first one is about the relative inflation rate. We'll see this in just a moment. If prices are rising, of course that means the price competitiveness of your product is going to mean that diminishes. Okay, so that's fairly straightforward, but this is relative. This is in relation to other economies. So you might have inflation rates of say 5%, but in another economy with which you are competing, you may have 10% inflation rates. So therefore, your economy would be more competitive than theirs. So it's relative, so you've got to bear that in mind. Secondly, and many of these other factors here are really on the supply side, labour productivity, so the degree to which labour is productive, that's also going to reflect the investment in labour that is actually taking place, the level of human capital within the labour force. So that's important. The quality of the infrastructure, so again another prominent supply side factor. Ease of doing business, again about the supply side enabling ease of market entry and exit thereby as well. And then finally the exchange rate. Is the exchange rate actually competitive, or is it priced too high? Are interest rates too high, and is that causing the exchange rate to be too high and therefore affecting your price competitiveness? Okay, so how is international competitiveness measured? Well, I've broken this down to 2 areas really. The first is through the terms of trade. Now this terms of trade concept, it's a nice straightforward one to understand. So it's an index, so it considers index values and then calculates from that index. So it's a measure of prices in relation to import prices. So let's take a look at the actual formula. So the terms of trade equals the index of export prices divided by the index of import prices times 100. So it's a nice simple one to actually work through, and it's possible you might get a multiple choice question on this in your essay, in your economics papers. Okay, so if your terms of trade is greater than 100, then it would signify an improving terms of trade. If it's less than 100, it shows a deterioration or a worsening in your terms of trade. So really what we're saying is, for a given basket of exports, what is the given basket of imports that you would receive in return if you were almost operating a barter-based economy? So let's just consider the nature of this and why this 100 figure is important. So obviously, being an index here, an index of export prices, we would start at 100. The index of import prices would also start at 100, so therefore we'd have 100 divided by 100, which would equal 1, times 100 equals 100. So that is our starting point. So really we're trying to ascertain what are happening to export prices in relation to import prices. Okay, now it's not necessarily correct to think that an improving terms of trade is always the optimal scenario. Okay, it does depend as ever in economics. So let's have a look at this straightforward example that I've just put down here. Terms of trade equals well, 102. So this is perhaps in year one after the index has been established. So export prices have risen to 102. Import prices, however, have risen to 104. So what does this show us? Well, it shows us that for a given basket of exports, we can now no longer receive that same basket of imports. And if we actually work through the calculation, I believe the answer there is about 98.1. So you end up with 98. So therefore, we can see it is less than 100, and that shows a deterioration in the terms of trade in this instance. What may also be problematic is the fact that the price of imports have risen, and that may contribute to cost push inflation, of course. So that could be a significant factor to bear in mind. Okay, you'll do more work on the terms of trade as a concept within the international economics area. Okay, it's an important one just to get to grips with. But just come back to these points. If you boost labour productivity, you can see that actually that's going to reduce your export prices, because the labour force will be able to produce those goods more cheaply, more quickly, and therefore the supply would increase. If the supply increases, the price of those export prices, exporting goods, would come down, and therefore your terms of trade would worsen. So the question is really, why have the terms of trade worsened? What is behind that underlying motive? So as I say, we'll look at this in more detail later. Okay, and secondly, through productivity and unit costs of production. So this could be labour productivity, and is usually measured in labour productivity, absolutely. So these are our two measures that we will generally use. In multiple choice papers, you may well see them broken down to the labour cost, the actual productivity per hour, as well as the unit cost of production in each of those areas. Okay, so why would you want to try and improve your international competitiveness? Well, of course, it refers back to the benefits of actually improving your current account position, and that would mean that you would be exporting more goods than you're importing, so you may start to or begin to run a trade surplus. That would increase your domestic demand, because exporters are earning more incomes. That means that there's likely to be employment opportunities within those export sectors. That's going to raise domestic demand. As I said, there's going to be a positive multiplier effect from that as well. So this is likely to be good for economic growth. And of course, raising your international competitiveness is a supply side element, or a supply side means of actually improving your current account position. Okay, now that should be fairly okay, you know, to get to grips with that, guys. All right, thanks a lot for joining me. See you next time.